Well, good morning. Happy Friday to you. I'm Marlon Bowling with you, your tour guide to the ag commodity trade. Well, it is Friday. It is the end of the week. We did have a bit of a higher trade in the overnight session, but we had some new information out this morning related to jobs data. And I want to bring in Brian Hoops, the president of Midwest Market Solutions. We'll sort this all out and see what that may or may not mean in the overall scheme of the markets. Brian, thanks for joining us here this morning. We had some jobs data that came out a little bit ago, and it was a bit of a surprise, and I wondered if you could explain what the numbers were and what they may mean to the outside markets and also maybe the ag trade, if anything.
Well, good morning, Marlon. Yeah, it's numbers. April non-farm payrolls numbers, jobless numbers that came out showed much more jobs added than what was expected to the trade. And unemployment rate falls from 3.6% down to 3.4%. So on the surface, it looks really bullish. That's a great sign that the economy is recovering. We're adding all these jobs, but it's that fuzzy government math where they tell us what we want to hear and then also tell us, oh, by the way, the last 2 months, we are revising them lower by 150,000 jobs. And so, it's like an equivalent of the government coming out next week in the supply and demand report and telling us ending stocks are actually 1.2 billion. And we rally corn sharply, but then wait a minute, the last months we were going to increase ending stocks, and it all washes out. But it's that perception anyway that maybe things are more bullish than what they want to look at on the surface, and that's really not the case. But nonetheless, U.S. dollar is rallying sharply this morning off of this news. It's affecting the gold and metal markets are falling sharply. Meanwhile, you have the stock market rallying on this news, and how it affects our commodities here is that dollar strengthening. We really don't want it to, because that makes our export markets appear even more expensive. And we just had fallen to multi-week lows in the grains, corn, soybeans, and wheat. We really didn't uncover any export demand to speak of. And now that we've rallied off our price levels, we're seeing the dollar rally. That's not going to help out our export market. It's something I think we want to watch and be concerned about, especially with these weather forecasts that I think look very good for seeding the crop and then getting it to germinate. That's going to be bearish longer term for prices in here. And then we are set to have higher weekly closes if we can sustain these gains that we saw overnight.
All right. Well, Brian, I get the feeling that the release of these government numbers are incorporating what I would call a rolling intentional error. And, they'll come out, like you say, with numbers that the trade wants to hear, but then they'll backtrack after it's passed by a month or two, and then they'll adjust those numbers back behind to a more negative number. And it's like they just keep moving forward in time and correcting the numbers back behind them all the time to cover their tracks a bit.
That's certainly what it appears that is happening. And we've seen this fuzzy government math before, and I think we're seeing that again here in these numbers that were released this morning.
Oh, boy. And it's not just in that jobs data. We see it in the ag reports all the time. Let's take a look at the overnight trade here, see where we ended up. And here on the grain trade, we'll start with the corn. Our quotes are provided by bar chart. We did trade higher overnight. July corn finished 4 higher at 593, almost on the high of the overnight session. December was 2 3/4 higher, and it closed at 531 1/4, only 1 tick off of its overnight high. In soybeans, you had July up 7 3/4 at 1425 1/2. That was sharply off of its overnight low by almost a dime. We had November trading 2 higher at 1270 1/2. In Chicago wheat, let's go with July. It was up 1.5 pennies at 646 1/2, so a little bit of a firmer tone there. Kansas City, though, 5.5 higher. July at 803 3/4. You know what's significant about that? It's above that psychological $8 mark. In Minneapolis, we had the spring wheat on July closing 6 1/4 higher, 818 1/4. And in the cotton market, we'll go with that same July contract, up 262 overnight at 84.38. I believe we were limit up yesterday, so we'll watch that one too. It's making big moves this week. We'll come back and talk more with Brian Hoops, and we'll talk about livestock right on the other side. All right, we're back talking with Brian Hoops of Midwest Market Solutions. So again, let's go back to all this outside information here. We have jobs data that came out this morning, stronger than expected. So is that a good sign or bad sign for meat demand?
Well, the fact that the dollar is rallying is probably not a great sign for our demand, but if these numbers were accurate, if you could believe them, you would think the economy is off and running and where everything is great. That should be good for domestic demand. I think that's should be tempered. That enthusiasm needs to be tempered because these numbers are likely to be revised lower. There's no reason to think that they won't be after March and February numbers were revised lower. So, the cash cattle trade this week is steady to the lower. A lot of feedlots are just kind of waiting and letting the cattle get a little bit more mature, putting a little bit more weight on them, getting them to more higher grade for next week. The problem is our packer kills this week about 630,000 head is I think where we're going to come in at after this Saturday's kill. That's really not enough to say that we're bullish. I really think you need to be looking at 650 to 660,000 kills each and every week to really see a surge in the cash markets. So we're putting in our spring high, pulling back in the cash markets here in the next week and probably next week or two before we take another run at higher prices into the summer. So numbers are still going to be tight. That does not change. That fundamental does not change anytime soon, but it's the technicals that are kind of weighing on futures in here and making things a little sloppy.
Well, let's take a look at our futures trade then, and we'll go with live cattle trade from yesterday. And how did we close? Well, on our quotes from bar chart, we had June down to 7 cents at 161.57. August down 12. The deferreds were actually just a touch higher out there. On the feeder cattle market yesterday, we had the August contract down 37 cents at 223.15. But the far out deferreds, October and November, were 10 and 25 cents higher, respectively. And if you look at lean hogs, well, we were down. June down 85 cents at 87.15. July down 107 at 88.25. If we can bring up the beef cutout values, I just wanted to point out the movement there on the choice and the select cuts yesterday. They have kind of held steady here, and they seem to be holding pretty firm here in the last day or so. Maybe we don't have those numbers handy there, but anyway, they have been kind of leveling off here the last few days. Just wanted to point that out. We'll look at those a little later on this morning. Brian, thanks for the time here this morning. I appreciate that, and happy weekend.
Have a good weekend.
Yes, we'll talk with you again next week. Brian Hoops of Midwest Market Solutions with us here on a Friday morning.